quarter was solid, beats both on the top and bottom line, really driven by higher than expected volume in their power and energy business, as you alluded to. But I think the real standout and the takeaway this quarter was really the unprecedented order and backlog growth that we saw. Now, we came into the quarter with backlog already sitting at a record level, but we saw orders increase more than 70%, which drove nearly a 30% increase sequentially in the backlog. And what's encouraging, it seems that it's pretty broad-based. It's not just the data centers and AI. It's construction starting to contribute, mining starting to contribute. So you're really starting to see a lot of momentum starting to build moving into 26 as we get these, not only the cyclical recovery start to materialize, but also the secular tailwinds kind of converging here.
So it sounds like a number of different drivers, and do they all move to their own timeline in terms of that cycle? They're all kind of hitting their stride at the same time?
Yeah, I think as we go into 26, you are starting to see those cycles converge. The more cyclical mining and construction businesses have kind of been bouncing along trough for a couple of years now. We're finally starting to see some stronger order activity and momentum building on the non-res and even on the residential side in North America. Mining, you're starting to hear of some more projects on copper and gold. And then obviously they can't add capacity fast enough when it comes to power generation. They're going to be more than doubling their large engine capacity through the end of the decade. So that's more of a supply constraint as we look here, at least in the near term.
Chris, so when you talk to institutional investors about your group, do people just buy the group, i.e. machinery, construction, and when the cycles are coming together and then sell them when they're not? Is that, or do I have to be real bottoms up on individual companies?
It varies, and I think it is becoming a little bit more bottom up. Historically, for example, trucks, right? You'd always buy when truck orders were at their worst and bottoming. That's a short cycle business. You'd kind of pile into those names at that point in time. Ag is a little bit idiosyncratic in terms of how those cycles work and a little bit detached from your traditional economic cycles in that it's more driven by crop prices and farmer incomes. And then construction equipment, certainly a more cyclical GDP type play. But what you're seeing now is you're starting to see some divergence between those names that have the data center AI exposure, like the Caterpillars and the Cummins of the world. And those have really outperformed over the last 12 months because of their exposure, where a lot of the other machinery names just aren't as levered to the data center play.
How exposed is Caterpillar to tariffs? I mean, there are some tariffs in place, and there's, on a daily basis, threats of new tariffs being put in place.
Yeah, if you want to pick apart one negative in the quarter, it was the tariffs. They did come in a little bit higher than we expected, and it continues to weigh on margins, particularly in the construction and mining businesses. Tariffs in aggregate were roughly a $1.7 billion headwind in 2025. That's going to step up in 2026 to about $2.6 billion. We've really seen Caterpillar kind of hesitant to push price to start to offset these. And I think that's really been a concerted effort to try to gain market share, particularly as we are at a softer part in the cycle. I think pricing is going to become much more of a contributor as we look into 26. Right now, they're guiding to about a 2% contribution on the pricing side, but I won't be surprised to see that go a little bit higher, particularly as some of their end markets start to recover.